G'day, Australia. James Walker here. And I want you to imagine two people. Both of them live here in Australia. Both turned 60 this year. Both stopped working. And both have almost exactly the same amount in superannuation, around $900,000. But here's what's going to happen over the next 25 years. One of them will hand the tax office, well, over $200,000. The other will hand them nothing. Not a reduced rate, not a discount, nothing. $0 in tax on their super earnings, and $0 in tax on every single dollar they withdraw to live on. Same age, same super balance, same country. The only difference is that one of them knew about a switch that exists inside the superannuation system, and the other didn't. And that switch, my friends, is what I'm going to show you today. Because if you're 60, or you're close to it, this is the strategy I would use the moment I qualified, not to bend the rules, but to use them exactly as they were designed. To stop paying tax on my retirement money, legally, permanently, and in most cases for good. I'm James Walker, and here on AUSPENSIONGUIDE, I make superannuation, tax, and the age pension make sense in plain English from your side of the table. I'm not selling you a product. I don't work for a super fund. I work through the rules the way they're actually written in the legislation so you can make informed decisions for yourself. And today I'm walking you through the single most powerful tax strategy available to Australians over 60. By the end of this video, you'll know exactly which lever to pull, in what order, and the one mistake you must not make while you do it. Let me start with something almost no one has explained to you properly. Your superannuation doesn't live in one place. It exists in one of two completely different tax worlds. And which world your super is sitting in right now determines whether you pay tax or you don't. The first world is called accumulation phase. That's where your super has been sitting for your entire working life. Every dollar your employer put in, every bit of growth, every dividend, quietly building up in that account. And the whole time it's been sitting there, your super fund has been paying 15% tax on the earnings inside it, on the interest, on the dividends, on the capital gains, every single year. Now, you never see a tax bill because the fund pays it out of your balance before you even look at your statement. But make no mistake, you are paying it. On a $900,000 balance earning, say 6% a year, that's $54,000 of earnings, and the fund is paying around $8,000 in tax every single year. And that's $8,000 that could have stayed in your account, compounding, growing, working for you. But instead, it's gone. Now, here's the second world, and this is the one most Australians have never been told about. It's called pension phase or retirement phase. Same money, same super fund, often the exact same investments, but the tax rate on the earnings drops from 15% to zero, not a lower rate, zero. The official name for it is exempt current pension income, and it does exactly what it says. The income your super earns while it's supporting your retirement is completely exempt from tax. Let me say that again, because this is the whole game. In accumulation phase, the tax office takes 15% of your super's growth every single year, forever. In pension phase, they take nothing. And that $8,000 a year isn't just a one-off saving. Over a 25-year retirement, that's $200,000 in tax. And that's before you count everything that tax would have earned if it had stayed invested and kept compounding instead of leaving your account. Now, here's the part that should make you angry, in a good way. The door between these two worlds opens the day you turn 60 and meet a simple condition. But no one sends you a letter. Your super fund won't ring you up. The tax office certainly won't. You have to know to walk through that door yourself, and that gap, my friends, is the single most expensive mistake in most people's retirement. So how do you move from the 15% world into the 0% world? You start what's called an account-based pension. That's the switch. And there are two things you need before you can do it. The first is what's called a condition of release. That's the government's way of saying you're genuinely allowed to access your super. For most people watching this, there are two clean ways to meet it. One, you've reached age 60 and you've retired. And the definition of retired for superannuation purposes is that you've stopped working, or you're working less than 10 hours a week, and you don't intend to go back to work more than that. Or two, you've simply turned 65. At that point, you can access your super whether you've retired or not. You could still be working full-time, doesn't matter. 65, it's yours. So 60 if you've retired, or 65 regardless. That's your key. The second thing is the act of starting the pension itself. You contact your super fund and you tell them you want to move some or all of your accumulation balance into an account-based pension. It's usually a form or a few clicks in your online portal. The money doesn't leave your fund. It doesn't go anywhere. It just changes worlds. It moves from the taxable zone into the tax-free zone. And the moment it lands in that account-based pension account, two things happen at once. The earnings inside the pension stop being taxed. That's the 0% we just talked about. And the payments that come out of that pension to you are 100% tax-free because you're over 60 and it's coming from a taxed super fund. Tax-free going in as growth. Tax-free coming out as income. That's the machine. Now, before I go any further, let me give you one practical tip that people miss. Before you start your pension, it's worth pulling any stray super accounts you might have into the one fund. You can only move what's actually sitting in the fund you're starting the pension from. And if you've picked up 2 or 3 super accounts over a working life, each one is charging its own set of fees and quietly shrinking your balance. So consolidate first, then switch. Now, I need to draw one very clear line here because people trip on this. There's a second, more limited thing called a transition to retirement pension, a TTR, which you can start at preservation age while you're still working. That is not the same as what I'm describing today. A transition to retirement pension does not give you the full 0% on earnings the way a genuine retirement phase pension does. It's taxed at 15%, just like accumulation, and it caps how much you can draw each year. So don't confuse the two. What I'm describing today, the real prize, is the full retirement phase account-based pension you start once you've genuinely retired or turned 65. That's the one that turns the tax off completely. Now, naturally, there's a limit because a benefit this good can't be unlimited. The tax office caps how much you're allowed to move into that tax-free pension world. It's called the transfer balance cap. And as of the 1st of July 2026, it sits at $2.1 million per person. Read that carefully because it's more generous than people assume. 2.1 million is the amount you can shift into the zero tax pension world. For the overwhelming majority of Australians whose super is well under that figure, your entire balance can go across. All of it. Every dollar earning tax-free returns from that point forward. And here's the part that couples miss. The cap is per person. So a couple can have 2.1 million each. That's $4.2 million sheltered in the tax-free zone between them. $4.2 million of super throwing off income with the tax office taking nothing. That's not a typo. That's how the system is designed. Now, everything I've told you so far is upside. Here's the catch. And this is the most important 90 seconds in this entire video because getting this wrong throws away the entire benefit. When you start an account-based pension, the rules require you to actually draw an income from it each year, a minimum amount. That makes sense. It's a pension. It's meant to fund your retirement, not sit there as a tax shelter forever. The minimum is a percentage of your balance, and it climbs as you get older. Under 65, it's 4% of your balance per year. From 65 to 74, 5%. 75 to 79, 6%. 80 to 84, 7%. Then it steps up again, 9, 11, 14% once you're past 95. To put a real number on it, on a $900,000 pension at age 60, the 4% minimum is $36,000. You have to draw that much each year, and because you're over 60, every single cent of that $36,000 lands in your bank account tax-free. So the minimum isn't a penalty. It's just the tax-free income you're going to live on anyway. That's the minimum. There's no maximum in retirement phase. You can take more whenever you want, and it's all still tax-free, but you must take at least that minimum. And here's the wire. You have to actually pay it out to yourself in cash by the 30th of June each year. Not calculate it. Not intend it. Pay it. Because if you don't, if the money doesn't physically leave the pension account and land with you before the financial year closes, the tax office can treat your pension as having stopped for that entire year. And if the pension is deemed to have stopped, you lose the exemption. That 0% on your earnings snaps back to 15% right across the whole year on the whole balance. You can turn a completely tax-free year into a fully taxed one by missing a single payment by a few days. I've seen it happen. Someone in Brisbane forgot to process their minimum pension payment in June, thought they'd do it in July, and it cost them over $11,000 in tax they didn't need to pay. So set your minimum to pay automatically. Put a reminder in your diary every May. That one habit protects everything else in this strategy. Now, so far we've turned the tax on your super off. Let me show you how that 0 ripples outward. Because this is where tax-free super quietly becomes tax-free retirement. Full stop. The income you draw from an account-based pension when you're over 60 isn't just untaxed. As far as the tax office is concerned, it isn't assessable income at all. It doesn't go on the taxable side of your tax return. And that has a knock-on effect most people never connect. Because that pension income doesn't count as assessable income, it doesn't push you up through the tax brackets. And it doesn't burn through the seniors and pensioners tax offset that can shelter your other income. So you can run your super pension income alongside a bit of other income, maybe some part-time work, maybe some bank interest, and still stay under the line where tax kicks in. The zero doesn't just apply to your super, it protects everything around it. And it isn't only the income that turns tax-free. The capital gains do too. And this is the part that catches people who've held good investments for a long time inside their super. Say there's a share or a property investment inside your super that's grown strongly over the years. If you sell it while your super is still in accumulation phase, the fund pays capital gains tax on the profit, roughly 10 to 15% depending on how long you held it. Sell that very same asset once it's inside the pension phase account, and the gain is exempt. Zero. Which means the smart order is usually to switch into pension phase first, and only then rebalance or sell. The capital gains you spent decades building come out the tax-free side of the door instead of the taxed side. Get that sequence backwards, and you can hand over a capital gains bill you never needed to pay. There's one more layer, and it's the one that genuinely delights people when they realize it works. If you hold Australian shares inside your pension, those shares pay franked dividends. Dividends that come with a tax credit attached, because the company has already paid 30% company tax on that profit. In the tax-free pension world, you don't owe any tax for that credit to offset, so the tax office refunds it to you in cash. Put a number on it. A $10,000 fully franked dividend carries about $4,300 of franking credits. In the pension world, you receive the dividend, and then that whole $4,300 comes back to you as a cash refund on top. That isn't just tax-free income, it's the system handing back tax that was paid on your behalf. Which is why fully franked Australian shares, the big ones, Commonwealth Bank, BHP, Wesfarmers, are so often the heart of a retirement phase portfolio. Now, I titled this video the way I did because I meant it, but I'm an advisor at heart, not a salesman. So let me be completely straight with you about where the wall actually is. 3 things sit outside this shelter, and you should know them so nobody surprises you later. First, money outside super. If you own an investment property or a big parcel of shares in your own name rather than inside your pension, the income from those is still accessible in the normal way. The good news is that the seniors and pensioners tax offset means a fair amount of outside income can still land tax-free, but it isn't automatic, and it isn't unlimited. Inside the pension is the zero zone. Outside it, ordinary rules apply. Second, the very top end. If your total super balance climbs above $3 million, a newer rule from 2026 adds an extra 15% tax on the earnings that relate to the slice above that $3 million. And even then, it only touches the earnings on the part above $3 million, not your whole balance. For most people watching, that ceiling is a long way up and simply doesn't touch you. I mention it only so you know the tax-free world does have a roof and roughly where it is. Third, and this is the one that catches families, what happens to your super when you die? If your super passes to a tax dependent, your spouse or a young child, it's completely tax-free. No issue. But if it passes to an independent adult child, which for most people means they're grown-up kids, the taxable part of that super gets hit with 15% tax, plus the 2% Medicare levy if it's paid straight to them. Call it around 17% on a large balance. That can be tens of thousands of dollars handed to the tax office at the worst possible moment. Which brings me to the last move, because there's a way to shrink that final bill too. It's called the Recontribution strategy, and it's how you defuse that death benefit tax for your kids. Here's the mechanics. Your super is made of 2 parts. A taxable component, which is the part that gets taxed when it passes to an adult child, and a tax-free component, which passes to anyone completely tax-free. The Recontribution strategy simply converts one into the other. Because you're over 60, you can withdraw a lump sum from your super tax-free. Then you recontribute that same money back into super as a non-concessional contribution, an after-tax contribution, and when it goes back in, it's classified as tax-free component. Same dollars, but now they'll pass to your children without that 17% bite. Here it is in numbers. Say you withdraw $300,000, all taxable component, and put it straight back as an after-tax contribution. It re-enters as tax-free component. If that slice later passes to your adult kids, You've just saved them around $50,000 in death benefit tax on that portion alone. It isn't a loophole. It isn't a scheme. It's a long established tax office recognized strategy. There are limits on how much you can put back. The non concessional cap this financial year is $130,000. And if you're under 75, you can bring forward up to 3 years at once, up to $390,000 in a single go. Two things matter here. You generally can't make these contributions once your total super balance is at or above the 2.1 million cap. And the ability to do it at all ends once you pass 75. So this is a strategy for your 60s and early 70s, which is exactly why I'm telling you about it now. So let's bring it all back to those two 60-year-olds we started with. Same age, same $900,000, same fund. One left it in accumulation and is quietly paying 15% on the growth year after year for the rest of his life. The other started an account-based pension, moved his balance into the tax-free zone, set his minimum to pay automatically so he never trips the wire, stacked his tax offsets around it, collected his franking refunds in cash and used Recontribution to protect what's left for his kids. Identical starting points. Completely different tax bills. One of them measured in the hundreds of thousands over a retirement, the other measured in nothing. That's the strategy I'd use the day I turned 60. Not because it's clever or aggressive, but because it's simply how the retirement system was built to work. And the only people who miss it are the ones nobody bothered to tell. Now you've been told. If this made the picture clearer, do me a favor and hit that like button. It helps more Australians find this information. And if you haven't already, subscribe to AUSPensiOnGuide, because every week I'm breaking down the super strategies, the pension rules, and the Centrelink changes that matter to you and your family. Leave me a comment below. Tell me where you're at. Are you 60? Have you started your pension yet? Are you still in accumulation? I read every single comment, and your questions often become the next video. Thanks for watching, my friends. I'll see you in the next one.